Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories that we're tracking for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney is expected to unveil an agreement with Alberta this afternoon that could clear the way for a new oil pipeline. The Alberta government has been negotiating with Ottawa to allow the proposed Pathways Alliance project to move forward, along with a proposed pipeline to the West Coast. The agreement could reset the relationship between the two levels of government. They have been at odds for some time now. And shares of Rogers Sugar are edging higher today, up about 1.25%, let's say. The sugar producer posted profit and revenue in its latest quarter that came in above expectations. The Montreal-based company says the results were driven by disciplined execution and consistent demand from its customers. It is currently focusing on expanding its refining and logistics capacity in eastern Canada to support evolving demand. And taking a look at the TSX right now, it is pretty much a flat day as we look at the numbers after the nice little rally it's seen that put it up into record territory. Still almost around 31,200, up ever so slightly. And of course, the American markets are closed and most of the groups right now are in the green, except for construction staples and materials. Markets took a drop earlier this month and then caused many investors to grow concerned. But my next guest says this week's rally in the TSX signals short-term indicators are strong. Bruce Campbell is president and portfolio manager at Stonecastle Investment Management. Bruce, thanks as always for joining us.
Yeah, it's a pleasure to be here. Thanks for having me on.
It's good to see. I think a lot of people are happy to see that little downturn stop right now. But you say short-term things are strong. What's giving you that confidence?
I mean, we look at a lot of different indicators, and when we went into this correction, we were a little bit surprised at sort of how severe it was, especially with more of the higher momentum names that are in the market, both in Canada and the U.S., because of the fact that we saw our longer-term indicators still being really positive. That being said, we, kind of in the midst of the pullback, we started to see, some of our shorter-term indicators showing some damage, but the intermediate and long-term stayed positive the entire time. And whenever we see that, that gives us a strong sense that it's just a correction, just a pullback, and really there was nothing fundamental behind it from what it seems like, because now we're seeing those short-term indicators improve as well.
And what is that telling you as we head into the last month of the year?
Yeah, I mean, if we look at kind of the year-over-year economic data heading into 2026, that all looks really positive, especially when we compare it to kind of where things have been. So we think that that's going to be, a strong backdrop for stocks in the first half of 2026. Throw on top of that we're seeing those indicators continue to be strong and not showing any sign of weakness. And it looks like, this was just one of those standard kind of run-of-the-mill pullbacks that we see, a couple of times a year.
And also one of the things you've been talking about, there's rotation, and you're seeing people make a little move there.
Yeah, I mean, even before this started, we had started to see under the surface a bit of rotation. So, for instance, the healthcare sector, which really hasn't done much most of the year, there hasn't been much focus there. And in fact, a lot of those names and companies had been declining probably since around the Liberation Day to probably around September, have now started to see some strength. And we're seeing it not just in regular healthcare, kind of more stability names, but we're also seeing it in biotech, which is fascinating because when you see biotech improving on aggregate the entire sector, that's really not a risk-off environment. That tends to be the other way around. So we're seeing that. And then the other interesting area is energy, which is, of course, helping the TSX for sure, in that, we've seen natural gas prices fairly strong, but we really haven't seen much strength from oil. But yet we're seeing really strong performance from some of the oil names. And you start to wonder, is that a couple of things? One, is deposit flow of funds back into Canada because these oil companies have been so strong with their capital. They've been really diligent on returning capital to shareholders either through buybacks or for dividends, and haven't been on this crazy spending train. And then the other thing is that starting to indicate that there could be some more strength in the economy heading into next year, and we haven't seen that yet in the energy price.
Okay, I want to get to some picks you have for us as well. Rocket Doctor, a healthcare software solutions company. What are you liking about that?
Yeah, I mean, if you see, there's been a bit of a trend here, certainly in Canada. I mean, we saw the draft legislation out of Alberta where they're looking at a two-tiered system. And what Rocket Doctor does is it's almost the Shopify of doctor platforms for doctors both in Canada and the US. It allows them to really offer their services virtually. The thing that's kind of interesting about that is that they've also built their own large language model closed database. So that's specifically only their information that they've loaded in. And it took, I believe around 7 or 8 years for them to do this. And that's a medical library that allows doctors to really triage patients before the doctor sees them. So for instance, you could have a nurse that ran you through a questionnaire, and then it would help the doctor to save time and also to be able to send a few different areas to refine exactly what's wrong or what could possibly be some of your ailments, and then to look at the different diagnostics that could help there. And they've been in Canada for a while. They're in the US now, and they're really expanding. We've seen some revenue from them, and what we're watching for, kind of heading into 2026 is that revenue to ramp up to the point where they're going to be EBITDA positive.
Okay, moving on now, ABAX.
Yeah, I mean, this is a really exciting one because they're in the exchange business. So, just like say the TSX, but they're doing it in this case for commodities, and they've gone out and built their whole platform and settlement. And they're doing it for a few areas that we haven't really seen in the past. The first one was LNG, and they've just started trading back in the summer as far as the contracts go, and we're seeing a huge volume ramp up. The latest one was they have wind futures now in Germany, which is also quite fascinating. And then behind the scenes with ABAX is they have a technology that's going to help with the actual settlement process to identify like who owns those contracts so that the settlement can happen quicker and more efficiently. And that's something that I don't even think has been built into the stock here. And if you kind of look at, what's happened with these exchanges, it continues to be a consolidation exercise across the globe. And I would suspect that as they continue to build up volumes, this will get taken out at some point in time. Okay,
almost out of time. We want to do Happy Belly Food Group.
Yeah, I mean, this is an interesting quick service restaurant brand. They're still in the process of really getting fired up, but they're now up to 75 stores that they're building out, and they're going to continue to grow, and it's going to continue to show up in kind of food courts and one-off locations across the country.
Okay, well, we'll leave it at that note there. Bruce, thanks as always for joining us.
Yeah, thanks a lot.
Bruce Campbell is president and portfolio manager at Stonecastle Investment Management. Up next, Prime Minister Carney has announced further limits on imports of steel to try and boost domestic demand for Canadian steel, also lumber mills as well. We'll have more on that after this. Okay, we're watching some of the big Canadian steel stocks closely this morning after the Prime Minister's announcement last night. The federal government announcing a slew of new measures aimed at protecting Canada's steel and softwood lumber industries. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, okay, an announcement by the feds. What kind of reaction? What are some of the details?
Yeah, so some of the details just in terms of the announcement, first of all, for anyone who may have missed it yesterday, when it comes to steel, the federal government announced a 25% tariff on $10 billion worth of steel products, also slashing quotas for steel imports. So for countries that do not have a free trade agreement with Canada, that's gone from 50% to 20%. For countries that do have a free trade agreement, except except the U.S. and Mexico. That's gone from 100 to 75% in terms of those quotas. That all starts on December 26th, so a month from yesterday. And Carney's saying this will open up more than $850 million in new domestic demand for Canadian steel. And we're watching some of these really big steel companies today in Canada to see how they're reacting to this. Algoma Steel, Russell Metals, Tree Island Steel, for example. And Algoma Steel in particular, you can see it's up more than 3% at the moment. Earlier today, it was up more than 5%. So really benefiting, you could say, from
Positive
this
reaction.
news. It's positive reaction. And part of that comes also from an RBC report talking about this. James McGarrigle of RBC Capital Markets, he says he sees these moves as a positive for the domestic steel industry. He still believes the Canadian market is going to suffer from oversupply. But he notes that the government's plan to reduce foreign rates for interprovincial steel transportation that should increase demand for Canadian steel and make Ontario steel more competitively priced. And this is the part where Algoma Steel seems to be benefiting today in terms of its stock price. He expects Algoma to see earnings upside next year. And for the most part, that's from the Buy Canada policy on steel plates. So Algoma already benefiting from that today and possibly more so by 2026.
All right, we're actually going to be talking about the Buy Canadian, and people are still doing it at the consumer level. We'll be talking about that in a bit. But let's talk about the other half of this. Softwood lumber also getting a hand. They've been hit really hard.
Yeah, I know. This is the other industry, right? We're seeing steel, aluminum, softwood lumber. These are the industries in Canada that have been hit hardest by the tariffs. And so some relief coming from the federal government as well announced yesterday. This is more in financial aid when it comes to relief. $500 million each to two different programs that have been providing financing to struggling softwood lumber firms throughout Canada. So this is on top of some financial aid the federal government has given in the past as well. The CEO of the Forest Products Association of Canada is speaking out, saying this is a step in the right direction. They feel that it shows the federal government knows the urgency of this. But some industry representatives, particularly from the U.S., they say this support risks exacerbating trade disputes, and it could actually result in the U.S. government collecting these subsidies at the border instead. So, it's we'll have to wait and see what happens, of course. But some say that this is also just not a long-term solution. In terms of stocks we're watching for here, Canfor is a big one today. West Fraser, another big one. Canfor down by just over 1%. You can see there. West Fraser was up last time I checked, but it might be, it's still up. Just a little bit. Yep. So these not benefiting as much, obviously. There's not as great of an impact in terms of these measures as there is for the steel industry, but definitely something to keep an eye on throughout today.
Okay, Lindsay, thank you for that. And we're going to talk more about the steel right now. That's BNN Bloomberg's Lindsay Biscaya. Now, for more on Ottawa's support plan for Canada's steel sector, we're going to bring in Keenan Loomis, President and CEO of the Canadian Institute of Steel Construction. Keenan, thank you very much for joining us.
Good morning, Roger. Thank you.
Initial reaction to the announcement. Does it go far enough?
Well, back in May, the Prime Minister announced that his government was going to liaise with the steel industry and talk about, obviously what the impacts of the tariffs have been and what we would like to see as a result enacted into policy to help us get through this very time. So all of the things, the buckets of announcements yesterday are all topics that we have been discussing with the federal government over the last number of months, sometimes on a biweekly basis. So they've been listening and they have responded in kind and basically given the steel producers. I don't represent the steel producers. I'm in the structural steel industry, so I represent everybody that engineers our steel to make our infrastructure. But I'm very privy to these conversations, and the steel producers did an analysis for the government that showed that at these levels, they can recapture a good portion of the domestic market. This is what they need to be able to weather these difficult times. And we're particularly focused on the domestic procurement aspect. There are more details to be announced, but we believe that we should be our own best customer, that there's a lot of domestic market share out there, not just for raw steel, but for fabricated steel as well, especially with taxpayer-funded projects. So we're very happy with this announcement. It does provide us with a little bit of certainty going forward.
And what are you following with the procurement? What's your concerns?
Well, the big thing for us is to make sure that all of the rules apply not just to primary steel, but to the derivatives industry as well. So again, we buy steel, we fabricate it, engineer it for our infrastructure. Thus far, everything that has been announced to protect the industry up until yesterday had only applied to primary steel. So the fact that all of these measures are now applying to derivatives, which are different, codes, different products when it comes to international trade. And so we're very ecstatic with that, because if you do not protect all of the various elements in the value chain, you're really not protecting the producers either, because it creates loopholes in the trading system. So that's been shored up. And just that directive, that mindset change in terms of procurement for us. Again, up until now, we've been really frustrated with the fact that this government and even the provincial governments, we seem to be the only Boy Scouts left anymore talking about our WTO obligations. Now, that old trading system is gone, and we really need to be mindful of, especially where our taxpayer-funded dollars are going. And so to have that directive, and have that directive then flow down into the provinces, because of course the federal government is one customer, but the provinces are the ones that build the hospitals, the schools, the bridges. So they buy more steel, and the municipalities even more as a result. And we know the municipalities, we know the provinces are looking for direction from the federal government, and we're headed in a good direction.
And just going back, what are some of the products that will be affected by this that would have been coming in from the U.S., and how are they going to be replaced from the Canadian side?
Yeah, the biggest impact is going to be on cheap Chinese dumped steel, unfairly traded steel that's been flooding our market, especially since the Americans have closed their borders to that market. And so what has happened is the floor price of steel in this country has now gone up. It doesn't necessarily impact, the domestic stuff, although, again, now the market has opened up a little bit more, but it's that stuff that is unfairly traded. We just want to go head to head on a fair basis. And so to keep out, the Temu steel, the not only dumped, but just, really low quality steel as well. So it's going to impact the private sector probably more than the public sector. The public sector, again, we're going in that direction of making sure that taxpayer funded dollars are going to support domestic. It's going to be the private sector, so the owners, the general contractors, they are going to have to pay a little bit more in steel, but we think that is well worth it to protect the domestic steel industry. And again, all parts of the value chain.
And for those companies, how much more will they be looking at when they turn to the Canadian steel producers?
Well, that's not certain. Obviously, now everybody's going to be going out to the market to see what's happening. Obviously, we have a month as well to adjust to this. So some projects that are currently in the pipeline, you have a little bit of opportunity to plan for that. But again, this is all about keeping out unfairly traded steel. We shouldn't be comparing, the price of domestic steel to the lowest possible amount that you could get here in this market, because that always involves cheaper steel, and more it's involving pre-engineered steel, and that's where the tariffs on derivatives is really helpful to us as fabricators and builders of our infrastructure.
And just one last question: any concern, any worries out of political repercussions from south of the border with this?
No, I don't think so. And I think, in fact, we're preparing ourselves for CUSMA renegotiations. One of the things that we haven't talked about yet that I think is going to be really important is increased enforcement and what's coming into our country. Because the Americans have, the 232 tariffs are ostensibly to stem the flow of Chinese steel coming into America. Why we've been caught up in that, that's something that we've had to deal with as a country over the last year, psychologically. But it is about the unfairly traded steel. So if we're acting as tough as they are vis-a-vis Chinese steel, and stepping up our enforcement so that they know that we're not going to be a transshipment point for Chinese steel to come in through the land borders, I think, in fact, we're positioning ourselves really well for renegotiations with the U.S.
Okay, we'll leave it on that. Then, Keenan, thank you very much for joining us.
Thanks for having me.
Keenan Loomis is President and CEO of the Canadian Institute of Steel Construction. Coming up after the break, this holiday season, Canadian shoppers are making some changes to their habits. We'll tell you what they are after the break. update you on some market movers, and we're joined by our Bloomberg equities reporter, Monique Malima. Monique, thanks as always for joining us. Let's get right to it. First up, National Bank Financial initiating coverage on Badger Infrastructure.
Yes, so Badger Infrastructure, their shares are up today, like you said, after they got an initiation at National Bank. They were initiated at Outperform as the analysts really see a lot of opportunities for growth for this company. They're currently the largest hydrovac excavator in North America, and they see that there's opportunity for them to grow even further, seeing potential for double-digit growth coming soon. And this is because the company's really been able to benefit from its large scale and its diversification. They work in the construction space a lot, but they're really diversified across the segments of construction. So they're not just focused on residential units. They're also going to see some of the benefits from the growth in data centers. We're seeing more and more data centers being built, and this is an area that they see opportunity for the company to work on that construction, especially as the residential space is slowing down. So that's why we're seeing the shares up and National Bank being so optimistic on this company.
And these are the ones that have the big tube go down and suck the dirt out using water, right? Is that what these guys essentially are, that Badger Infrastructure?
Yes, exactly like you mentioned. It's the trucks that pull up.
All right. Oh, guys love looking at trucks like that. Okay, gold and silver stocks for metals, any of them, how are they doing with all the macro factors that's playing around right now?
Yes, so the gold and silver stocks in Canada, they're down this morning. They've been really moving a lot recently off of some of those macro factors like you mentioned, particularly out of the U.S. A lot of the focus right now is going to be on the path for U.S. interest rates. The U.S. Federal Reserve is making a decision in December on whether to cut rates. And while most people right now are predicting a rate cut, there's still a lot of uncertainty around whether that will happen and also what the path is going forward. And that's what's continuing to weigh on these shares. These stocks and these metals tend to do better when there's lower interest rates just because they don't offer yields compared to other assets. So until we get some more clarity around where the U.S. is headed for interest rates, there's expected to be some more pressure on them.
Okay, Monique, thank you very much for that. We'll leave it there. Bloomberg's Monique Malima. Well, despite financial pressures this holiday season, a new report shows that 80% of Canadians not only prefer to shop Canadian, but they're willing to pay a premium of 10% more. That's according to Boston Consulting Group Canada. Let's get more on this from Kathleen Polsonello, head of Boston Consulting Group Canada. Kathleen, thanks very much for joining us.
Thanks for having me, Roger.
So we haven't really seen a fade then of the shop Canadian, the elbows up, and we got to buy Canadian. People are still willing to do it.
That's right, Roger. At least for now, we're seeing a lot of different dynamics in the market this year, but that trend is continuing.
And where is the focus on that? Where are Canadians willing to say we're Canadian? Gosh darn it.
Well, it's very consistent with what we're seeing this time of year for how Canadians are shopping Black Friday and the holidays, which is in a few select categories. They're spending their money in apparel, electronics, and beauty. And in those categories, they're looking at really the non-discretionary type of spending. So things I need for the house, my family, versus things I'm splurging on. And that is also where they're buying Canadian.
And that's paying off for those companies. It's good to see putting the Maple Leaf on. I can't lie. I go shopping. I do look for the Maple Leaf and try and shop Canadian as much as I can. Now, I'm curious. 80% have said they would be willing to spend a premium of 10%. Were there any Canadians that said they would spend more than that? Or are a lot of Canadians also having to make a decision that they have to spend what they have?
Yeah, it's a great question, Roger. I mean, I think the reality is that Canadians continue to be quite worried about inflation. For context on Canadian household finances, we still see 45% of Canadians, that's nearly half, that are less financially secure than last year. We see 1 in 3 households who wouldn't be able to cover their expenses for a month if their income stopped. And so we do have to remember that Canadians remain squeezed. And those dynamics, translate into a significant portion. In our research, we saw close to 90% of consumers say that rising prices for essentials are a major concern for them. 83% are worried about prices going higher. And so whilst they may say that they're willing to pay more, in the grand scheme of things, this macro anxiety is high in Canada, and it's higher than other markets that we survey around the world, including the US.
I bet it's a challenging time for a lot of people. Going back to the non-essentials for a second, though, did people say why they were hesitant to shop Canadian there? Where you didn't see the same numbers that you would see with the essentials?
No, I mean, the reality is this time of year, especially with the deals for Black Friday, Cyber Monday, and as we go into the holidays, folks are very focused on those essential categories and getting deals on them. And it is a time of year for deals, right, Roger? What we're seeing is during Black Friday, consumers expect and are looking for at least 30% off from the retailers they're shopping at. And so it's a great time to buy those essential products.
And one of the things I was fascinated by was the percentage of people that are going to use AI to help do their shopping. It's really showing where AI is moving, how it's moving into the consumer realm now.
Sure is. I'd say that's probably one of the most interesting pieces of insight we generated in the report. For the first time, we see 40% of Canadian consumers using AI, and they're using it primarily to compare products and find value. And so it's a disciplined, data-driven consumer behavior. Now, of course, the reality is we still see use of Amazon. It's the number one influence for purchase decisions, Google, YouTube, brand websites, and of course, in-store advertising and flyers. I mean, that is still the bulk of where folks get their information. Don't get me wrong. But AI is starting to impact the way people shop, and it's particularly true for Gen Z and millennials. They're up at about 50% of them using AI to shop.
The kids always leading the way, aren't they? And the parents are playing catch up with it. And is there all indicators that it looks like more people will be going that way as well, to turning to AI for help on this?
That's what we're seeing, and the reality is that we're also seeing our clients in retail starting to gear themselves up for that. For a long time, our retail clients were indeed and continue to focus on how they show up in a Google search, how they leverage social media. But now, it's critical that they also are working on how they show up in an AI context, and how it is that their websites are well geared to enable that search of their websites and the scraping that the AI models are doing to enable this consumer research.
Okay, Kathleen, thanks very much for joining us.
Thank you, Roger.
Kathleen Polsinello is head of Boston Consulting Group, Canada. Up next, the Alberta government is expected to sign a memorandum of understanding with Ottawa for resource development. It's happening today in Calgary. We'll have more right after the break. Prime Minister Mark Carney is expected to unveil plans today for a new oil pipeline deal with Alberta. The Alberta government has been negotiating to allow the proposed Pathways Alliance project to move forward, along with pipeline to the West Coast. There are reports the new agreement will require a 75% cut in methane emissions over the next decade. A tanker ban implemented in 2019 currently blocks a new pipeline from being built. Ottawa has yet to say whether it would end that ban. Canada's current account deficit shrank in the third quarter. Data from StatsCan shows the deficit narrowed to just under $10 billion. It was led by a contraction of trade in goods as exports rose while imports declined. Investment income and trade and services also contributed to the overall narrowing of the deficit. Shares of Rogers Sugar are edging higher today, up by 1.5%, 1.6%. Sugar producer posted profit and revenue in its latest quarter that came in above expectations. The Montreal-based company says the results were driven by disciplined execution and consistent demand from customers. It is focusing on expanding its refining and logistics capacity in Eastern Canada to support evolving demand, according to the company. And let's go live now to Calgary, where Prime Minister Mark Carney is with Alberta Premier Danielle Smith to announce an MOU.
With the removal of the emissions cap on Alberta, as well as the removal of the net zero power regs, I think is going to unleash an incredible amount of investment and allow us to work together on important nation-building projects. So it's the first step, I think, of what will be a few more steps we have to take together, but I'm very pleased that the Prime Minister has heard our concerns and responded to them.
Thank you very much, Premier. And look, it's a great day for Alberta. It's a great day for Canada. And, at the heart of what is a multifaceted agreement, we have more work to do going forward, but a multifaceted agreement. In effect, it creates an energy transition, all aspects of energy, but really sets the stage for an industrial transformation. At the core of the agreement, of course, is a priority to have a pipeline to Asia. That's going to make Canada stronger, more independent, more resilient, more sustainable, because the way we're going to do that is in combination with the Pathways project, which will be the largest carbon capture project in the world. It'll mean that Alberta barrels of bitumen are amongst the lowest energy intensive in the world, therefore competitive not just for tomorrow, but for decades, as well as creating a whole new industry for Alberta and for Canada. In addition, agreements, or at least intentions around nuclear power, interties with other provinces, sovereign data centers, huge opportunity, huge necessity for Alberta and for Canada. And it's all done in a spirit of cooperation, partnership, and trust. So as the Premier just referenced, some adjustments to regulations, adjustments here in terms of strengthening the tier system, methane regs, enhancing methane regs, a cooperation agreement on regulation, which will help us move forward more efficiently and effectively. And also, just on the point of cooperation, at the heart of this is cooperation, partnership with Indigenous peoples in Alberta, in British Columbia, as they're affected. Unprecedented opportunities for Indigenous ownership, partnership, economic benefits, as well as substantial economic benefits for the people of British Columbia. So this is Canada working. This is cooperative federalism. This is Canada building with Alberta, building with Canada, building for today, but building very much for the future. And I'm very grateful, Premier, for your hard work and the hard work of your team to get us to this point. We've got more work to do, but we're going to work hard to do it. Et puis en français, bon, mon Dieu, juste plus fort que ça. Alors c'est un grand plaisir de revenir en Alberta. J'ai grandi ici en Alberta. Et c'est une bonne journée pour le Canada, pour Alberta.
All right, you've been listening to Prime Minister Mark Carney and Alberta Premier Danielle Smith announcing their memorandum of understanding regarding an oil pipeline to the West Coast. Some of the points to it, we didn't get full details yet, but they call it a multifaceted agreement for an energy transition as well, and a priority pipeline to Asia. The things they're talking about, it will include one of the largest carbon capture projects ever, and they talked about the unprecedented opportunities for Indigenous groups in Canada. We will be getting more details, and as we do, we will pass them on to you. Coming up, we'll hear from the CEOs of two big U.S. retailers on their plans for winning the holiday season. That's next. High stakes for retailers this holiday season as Burberry and Bloomingdale's look to attract buyers amid inflation and tariff pressures. Bloomingdale's CEO Oliver Braun says they're bringing back the golden age of the iconic department store, while Burberry CEO Joshua Schulman says they're the only luxury brand of scale with a uniquely British heritage. The two CEOs spoke to Bloomberg Television's Romaine Bostick.
'Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing, and we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season, from personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're refocusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You can buy a candle for $130 to one of our iconic made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas, so I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
Coming up, we'll check in on the TSX as it flies solo today. Ottawa threw the beleaguered softwood lumber industry a bone, with Prime Minister Mark Carney announcing new supports for both it and the steel industry. CTV's Andrew Johnson has more.
It's a company that wears Canadian pride on its sleeve, but Leslie Forest Products in Delta, BC isn't sure the federal government has its back.
It seems like they're more focused on, the issues back east, whether it's energy or, the auto sector.
James Sangera says the federal measures to help the industry announced today won't make much of a difference here, but he knows what would.
Work out a deal, reduce the duties.
Sangera says his family's softwood lumber business has constantly adapted to survive, but this year has been a challenge.
My dad's never laid anybody off in our 52 years that we've been here. He's always kept the mill running.
The softwood industry has been hammered by a combination of U.S. duties that have tripled and new Trump tariffs announced last month.
Profit margins are so low. Instead of manufacturing fencing and decking out of this wood here, the company says it's sending the wood down to the U.S. unfinished and doing the work there to avoid some of the tariff hit.
That wood that we shipped down there, that would have kept us busy for a couple weeks. We're scrambling to find work just to keep our guys going until Christmas.
The message from the mill is being echoed by advocates who also feel the industry doesn't get the attention it deserves.
I think the announcement today was basically for steel. I think it'd be great if I was in steel. I feel like we're in the moment of Sophie's choice where softwood lumber is going to be the child that's left behind.
They hope that's not the case here, and 2026 will bring some badly needed stability. Andrew Johnson, CTV News, Delta, BC.
Well, more Americans are opting for a different kind of buzz to go with food and family this Thanksgiving. As California state laws around cannabis have loosened, it has spread into everything, including the holiday spread. Bloomberg's Charles Gorovan has this report.
More Americans are opting for a different kind of buzz this holiday season. As state laws around cannabis and other drugs have eased up, it's spread into everything, including the holiday dinner table.
It's more accepted. It is becoming more normalized.
Cannabis's newfound place at family functions speaks to how far the category has come. The move fits the lifestyle of people who describe themselves as California sober, abstaining from or barely touching alcohol, but open to substances like cannabis or psilocybin. Alcohol consumption has fallen to its lowest level in decades, according to a recent Gallup poll. Over half of respondents to a recent Bloomberg Intelligence survey said they now substitute cannabis for alcohol at least weekly. That might take the form of gummies, extracts, and even infused seltzers. Cannabis on Thanksgiving is a quiet tradition for some. The day before Thanksgiving is the second biggest sales day of the year for the US legal cannabis industry, behind only April 20th, or 420, which is the de facto holiday for cannabis celebration. The industry was valued at just over $30 billion last year, according to industry estimates. The cannabis market tracker BDSA forecasts growth in the total market this year of 4% to $31.6 billion. It expects the market to reach $39.1 billion by 2029. For the big Thanksgiving meal, some chefs are getting experimental. Miguel Trinidad, a New York-based chef and founder of the cannabis dining club 99th Floor, is infusing THC into his Thanksgiving menu.
Our mission statement at 99th Floor is to destigmatize cannabis through the language of food. The way I do that is by micro-infusions. What I'm making today is going to be a rack of lamb.
Trinidad infuses lamb fat and clarified butter with cannabis flower before sealing and cooking the lamb sous vide, a slow water bath method that keeps the meat tender and evenly cooked. He then finishes it off in a scalding hot pan.
So here you have it, the infused rack of lamb. It's 5 milligrams of THC. Over the course of the time that I've been doing 99th Floor, things have changed. There's a lot of people that are coming out of the cannabis closet. It's something that's becoming normalized, and people are starting to understand it and respect it more.
While a few dozen states have legalized cannabis, it's still considered a Schedule I drug, putting it in the same category as heroin and LSD. Uncertainty at the federal level looms large, limiting access to banking, investment, and broader legitimacy. In August, President Donald Trump said he was considering reclassifying cannabis as a less dangerous drug, but no announcement has followed. The divide between state legalization and federal prohibition remains one of the biggest hurdles for an industry still finding its footing. In the meantime, the cultural shift is making its way into some holiday dinners.
And Market Call is coming up next. Today on the show, we have Mike Philbrick. He is the CEO of Resolve Asset Management, and we'll be taking your questions on exchange-traded funds. All right, let's take a quick look at how Bay Street is trading. Of course, Wall Street taking the day off for Thanksgiving and football south of the border. So you can see the TSX pretty much having a wash of a day. It's up ever so slightly. Most of the sectors, though, are in the green. Just construction staples, consumer staples and materials are the only ones off. But let's take a look at a couple of stocks that might be benefiting from the announcements regarding steel and the lumber industry. Algoma Steel right now, it is up close to 5%, 4.75% over those announcements, more than likely. Canfor as well, another one we want to look at here, see how it's doing in the wake of the announcements that some help was coming for lumber and steel. And Canfor is up, it's down actually right now, 0.82%. And Russell Metals, I just wanted to, one last look at that. It is off a little bit, but 1% right now. We'll leave it there for the day. Thanks for watching Morning Markets. We'll see you back here tomorrow.